Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping, 4% credit card fees, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 15,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, Eric, the rally has continued and the gold bull is back here. Second half of this week, big moves for gold and silver. Silver just about hit $16 earlier day today, trading back around $15.60 right now. And gold also a really big week. Last week's show we were talking about whether we'd see a little bit more of a smash down with the COT structure set up in gold and silver, but we've seen the opposite. We've seen the rally extend to 1280 today in gold. Gold's pulled back a little bit here in the afternoon, but still we're trading mid 1260s here to close the week. Very strong, very impressive performance this week for both gold and silver.
Yeah, indeed, and we did see a cartel attack, and particularly on Wednesday of this week. And it's also interesting that they snuck in and tried to push the metals down in between their reporting, with the cutoff for the COT numbers being Tuesday. It's frequently the case that when they're managing their book, the bullion banks, you can do some shorting and cover some shorts and so on. And though they are directly responsible for reporting the numbers, and that the CME managing Commitment of Traders report that is published every Friday, they don't do anything when it comes to auditing these numbers, whatever. They just take it directly from the bullion bank. So ultimately, we really don't have 100% certainty that these numbers are something that you can take to the bank, forgive the pun. But all things considered, they do manage their book, and so it does help to some extent in trying to predict when they'll attack. And we did see attack on Wednesday, but again, it's this amazing pattern that we've seen, particularly with gold, but also silver to some extent as well, ever since basically starting this year, where attacks will come or profit taking will come, and then we'll have a period of consolidation. And for the better part of this reboot of the bull cycle, we've seen horizontal consolidation. And now we're even seeing consolidation with an upward bias, the rising wedge pattern that technical traders love to see, with gold going over the 50-day, moving over the 200-day, the tail end of last month, and the nice momentum that we've seen. And we definitely have gotten the paper traders joining the party, and that's part of what has created this huge move in precious metals. I mean, gold was about 1,050, give or take, turn of the year, or at the nadir in the January period, when it was taken down after the first couple days of enthusiasm in the turn of the year. And ever since then, we went up to intraday basis, actually today being the period that we've it took out the last 1263.90 cent spike high back on February 9th. And instead of going down, we've just consolidated with an upward trend. It's amazing. This is the kind of stuff you'd expect to see in a regular bull market, and that we've been able to see that in gold in particular, but with silver being dragged along as well too, is all the more impressive, simply because there was so much expectations that the Fed was going to continue to raise interest rates and all of that other nonsense. I mean, the precious metals community obviously didn't across the board buy into that paddlum, but the 95% of managed money around the world that sloshes around with hands of people that don't pay attention to what we write about, and et cetera, or zero hedge or what have you. They're here, and that leads us to one of the most interesting stories that broke today. BlackRock suspended new share issuance for the gold ETF that they manage, and they're citing the fact that they have insufficient access to bullion to issue more shares. mean, it's a temporary suspension, but it's still very, very significant.
It is, and let's talk a little bit more about the significance. I mean, even though it is a temporary suspension, from what I've seen, there's no specific date mentioned. Yeah. And what does that do for sentiment as far as the physical gold market and then spilling over to the physical silver market?
It signals to the paper traders that they have a tight market on their hands, and that it's not some kind of academic proposition or something from the conspiracy gold bug community. It's coming from the organs directly of the institutional traders of BlackRock, and BlackRock is stuck. They, maybe. We always have this whole weird phenomenon with these ETFs, and it goes back to the very beginning days of when the World Gold Council was marketing GLD, the granddaddy of all of the gold ETFs. And the arguments at the time were, well, this is going to be good for the business, good for precious metals industry, because it'll create an easier way for investors to purchase gold and to control it. But as we have seen, GLD was a honeypot, and through the process of, particularly since April 2013, when we had that gigantic attack, ever since that period in particular, we saw GLD's inventory halved as the arbitrage of the bullion banks and just traders in general were basically raiding the thing. Gold was falling in price, and the authorized participants who could redeem 100,000 share baskets for the physical gold in the inventory were doing just that, and that helped create the duration of this very painful bear cycle that we've been in since 2011. So, the ETFs have always been a mixed bag, and then there's always been this kind of cloud hanging over them as well when it comes to the nature of their prospectus and the fact that, we've already seen documented cases where serial numbers that are associated with one bar ends up being in the bar list of, some other institutional investors' holdings per what they had noted, and that was a real embarrassing scene where I think it was Bob Pisani was talking about a particular bar when he was bringing the CNBC cameras to do an interview and do some photographing of what was going on with the inventory, and then somebody had actually discovered that serial number for that 400-ounce bar was actually supposed to be in their own allocated inventory somewhere else. So there's definitely weird things going on with these ETFs. But the bottom line is that when it comes to the short-term move that we've seen, even if they have this kind of song and dance, playing around the edges when it comes to not, being upfront with the inventory, and that there may be some game playing here, they still are being pushed up against the wall just by the sheer speed of this move in gold. And keeping up appearances of running the operation cleanly, if in fact that's what's going on all the time. And enough said, I don't think that's the case, and we can make those assumptions. But the bottom line is that with all of this fog of war, this war of precious metals versus fiat paradigm, this is an inflection point. It shows the Wall Street traders that the game of musical chairs is coming towards an end. It signals that the music is stopping, at least for a period of time, because frankly they just can't get gold to issue new shares, and the demand for new shares is here. So I think that was probably more important than any reaction to the job numbers. The job numbers were the typical kind of pablum that we're getting out of the Labor Department now, where we have huge boost in short-term and temporary work, and very few manufacturing jobs, and on and on. The whole notion of drawing a sense that we're going to have a recovery from the kind of economic humming of the American engine is it's silly. And Dave Franzo put out an article as well about this, and we'll link to that. But I think it's a combination of people recognizing that the economy is not as strong as the powers that be would like everyone to believe, with also this interesting news from BlackRock that coalesced today and created a pretty big snapback move in precious metals.
Looking in the short term here, Eric, with BlackRock suspending the ETF issuance today. Looking forward to next week with the FOMC meeting. Are we looking at the possibility of a very unusual squeeze to the upside on the FOMC, or do you think short term the cartel is still going to try their typical smash down? Probably now would likely be short-lived versus previous occurrences. So I guess is your take that one of caution here going into next week, or do you think they're on the verge of having the cartel's short position being squeezed? Really, for one of the only times in the bull market, 2011 is the only time that I can think of that the cartel positions on the COT structure were squeezed to the upside.
Yeah, I don't think we're going to see a major squeeze, but I do at the same time expect that we've had pretty high momentum and we've had a pretty significant move in precious metals, so we're vulnerable to the downside for any kind of pressure action that the cartel would take. And you also have to assume that this whole episode with the BlackRock suspension has the stewards of our monetary system a little bit nervous, because they can see the same thing that we see as we record here with an hour and a half left of trading on our Friday. The precious metals moved across the board, and I'm sure that that's sending up warning signals. So next week we will no doubt see some kind of a concerted action from the cartel, and whether or not it gets anywhere is an open question. And I think that the more I would describe it in terms of scenarios, because this is kind of a fluid situation where it's really hard to nail down anything that has like 70% probability or higher kind of situation. So making a formal forecast for a singular directional call is difficult. But the highest probability scenario would be the Federal Reserve and the Treasury and the plunge protection team, et cetera, all rowing in an effort to jawbone the markets with the expectation that the Fed is still going to try to do interest rate hikes later this year. They're not going to do anything in the near term, and they're going to try to package that spin and jawboning in the context of the fact that the stock market has resuscitated itself magically with their help and the liquidity that's come. And China has also been a party of that as well too, because they've been lowering reserve requirements in their banking system and doing direct injections of credit as well. So China is back pushing, and it wasn't all that long ago that Mario Draghi was reiterating his "we will do whatever it takes" mantra to resuscitate the European banking system. So this whole effort of trying to spin and manage prospective economic expectations with the notion that the Fed is going to do another 4 interest rate hikes is just complete fantasy. And that said, that's going to support the precious metals complex. It's part of the reason why the precious metals have moved as much as they have since January 1st. And next week we'll probably see an attack, and then another period of horizontal consolidation where whatever downside action they're able to instill, it'll be short-lived, and a week later will not even be remembered. And that's the way I would characterize whatever's going to happen next week when it comes to management efforts. So in other words, no waterfall-style crashes or anything like that, because the underlying demand for physical and paper, and that's really important because the paper traders are back. They're seeing all these technical signals, and they're wanting to scoop up the slop that is issued by the cartel when they do naked shorting. And so it does have a direct impact in making it very difficult for price suppression efforts, and it is in fact a straw that breaks the camel's back, so to speak, to torture the metaphor of what in fact flips the cartel over to the decision of a managed retreat mode. And we're seeing that. That's where the trading clearly indicates is what's going on, and we're going to continue to be in that mode. So the next week might see some pain just because we've had such a big move. But, here we are, Friday, jobs report. They can't get anywhere on the downside, and we've seen that a couple of times in this year, but it's very rare. I mean, all of the typical patterns that you would note that are indicative of, what the cartel has done over time are, in fact, breaking down, and that is the very definition of a managed retreat process unfolding.
Yeah, history tells you to expect a smash down next week, and I'd agree with Eric that if we do see one, it would likely be short-lived. But I don't know, I have a sneaking suspicion, my gut's telling me that gold and silver have the Fed in the corner. I think if Yellen says, damn the torpedoes, we're going to continue with more rate hikes, you're going to see gold and silver explode higher, contrary to what Wall Street would think. And on the opposite of that, if they backpedal and the market sniffs out, hey, NERP and more QE is coming, I think gold and silver respond the same way, similarly to how they responded with the QE1 announcement. That's just me. That's just kind of the sense and the feeling I get with the market here. We'll see.
Yeah, and the market is very different now. And I'm always amused by the fact that, people on CNBC or Bloomberg can sometimes overthink this when it comes to analyzing what's happening. But all one needs to do is look at the gold's trading this year and how significant the patterns have been when it comes to, momentum. If you look at the, say around January 16th or so, and I don't have exact date on that, I apologize, listeners, but it was about $171 on a spot basis. And as far as the intraday nadir, and gold ran up nearly 200 points to 1263 by February 9th. And that February move in particular was like a 70-degree near hockey stick move. I mean, for all the way through February 9, with the exception of a single day where we closed trivially to the downside, gold basically did a hockey stick move. But instead of falling back afterwards, and when you had profit taking and the cartel also helping along, particularly with their attacks on silver at that time, instead of falling back, we maintained a 40-degree slope line or so as accumulation continued on through the rest of February and March. We had a couple down days that were nasty, but this is an amazing pattern. Instead of, we almost hit on a relative strength index almost 90, which is sky high, and that we have been able to move in sideways with silver and with an accumulation pattern, a pennant pattern, as technical analysts would call it, a rising pennant, is the kind of signals that are making the paper boys go nuts. That's why we have been seeing a lot of accumulation in the COMEX hours. Yesterday was a great example, Thursday's trade. So this pattern speaks to the reboot of a bull market, even though the CNBC, Bloomberg, and talking heads crowd can't, speak about this honestly. But if you took gold's chart and say, divide the prices by like 40 just to camouflage what it is and rename the chart and stuck it before somebody on CNBC, the anchors would be looking at that going, wow, this is an amazing gold pattern. This is the classic bull market action. And somebody should do that actually to embarrass them.
And as to evidence a little further, Eric's claims that gold's trading differently and is indicative of a new bull market. On a 5-year chart, gold this week has broken out of its downtrend channel that has contained it all the way back to 2013. And now we're recording this at 3 p.m. on Friday, so outside of a gold close about $20 lower here, back below $12.50 here today, gold's going to make a weekly close up above the top of the downtrend channel that had held it ever since this correction began about 5 years ago, which is definitely significant, and in my mind, confirmation that we have shifted from the correction to the early stages of the next bull move.
Yeah, and we have not seen the relative strength index shoot as high as it did earlier this week, going back all the way to 2012. which, and I'm basing on the spot basis for COMEX Trade Gold is where I'm looking at that chart. In fact, I'll include that 5-year chart because it's kind of interesting to see. So, we've had this huge burst of momentum, yet at the same time, if you look back, for example, in 2013, the last time that we went over 70 very high on the RSI, that was a momentum peak, and then we slided downward. But instead, now we're seeing sideways action and accumulation upwards as well. Sideways with gold, with silver, and upwards with gold. So this is definitely different style trading patterns, and a lot of people in the stacker community have a real aversion to technical analysis, and this isn't necessarily using technical analysis to describe a forward-looking scenario per se, but just to use it as a tool to look in the rearview mirror and analyze what has been going on in terms of just simple changes in the psychology of the market. So I'd encourage people to not be in knee-jerk fashion rejecting use of technical analysis in this particular way, because it's useful. It gives people a sense of where the market has been. It's kind of like a tool to understand the history of markets, and
it still applies as far as momentum. I mean, the cartel has to fight against that because they have funds.
Exactly.
They have funds looking at those same charts and reading them in a classical manner.
Yeah, and the most important factor is that a whole heck of a lot of conventional money pays attention to this stuff, and that's what makes it relevant, because 95% of the money managed worldwide are managed by conventional thinkers, and a gigantic percentage of those money managers really just follow technical analysis and not much else other than reading headlines or whatever. I mean, they might know a little bit about fundamental analysis, but they're not rocket scientists. So this stuff matters, folks. Don't get all dogmatic about it, and don't yell at us for talking about technical analysis. Be a little bit more nuanced in understanding that it's a great tool to understand momentum, and that's really what's going on now. The paper traders have joined the party, and the people who are more serious of the smart money recognize that we're in the end game process, and that's why the precious metals bull has been rebooted, because the demand is just too great for the powers that be to suppress or to overcome.
The physical market is really only confirming that. U.S. Mint, here we're only 2 months into the year, and they've sold 11 million Silver Eagles and 500,000 ounces worth of the silver ATB coins. So, I mean, the U.S. Mint's on pace for really just about 70 million ounces of silver here in 2016, which would shatter all-time records. And really, it's astonishing that the U.S. Mint's put out 11.5 million ounces of silver in the first 2 months of 2016, and they're still on allocation. I mean, that just speaks to exponentially higher demand than we've seen in previous years outside of really the last year or two, and much higher. I mean, it's 50% higher than the last 2 years, and we're not at the lows anymore. So it'll be interesting to see how long the physical demand continues, but one would think that it's likely to get only stronger, particularly if the BlackRock suspension persists really for any increased length of time at all. Any sort of panic into physical, out of paper into physical, I mean, the market's going to be no offer. I
just had a really amusing thought pop into my head, and I'm going to share it with our listening audience. Maybe somebody out here who is creative would like to go and run and do this thing. But hey, we should run a Kickstarter campaign for the United States Mint with a $3 million target so that we can order them some new mint presses and stamping equipment so that they can't give the BS story about, it would cost us $5 million to, expand our production line. And that's the reason why we don't want to deal with any big changes in our, ability to deal with inventory needs and demand spikes and whatnot. Because that's the other half of their argument about the blanks,
Even though they've had $23 million in profit in the first 2 months of 2016.
Yeah. And making coins, and particularly the collectible coins that they produce, is a very profitable enterprise. There's no reason why they.
Yeah, I mean, to put the numbers in perspective, A-Mark, which we talked about last week, they operate on a 45 basis points, and most private mints in the country are smaller than that. A private mint is going to sell silver rounds on around 40 to 45 basis points. And that includes acquisition of the silver, that includes minting, that includes... And they're not like the U.S. Mint. They're not just releasing at their facility. They're shipping and insuring.
Right.
The U.S. Mint is running $2 spreads just to release and say, okay, come pick up your coins.
Yeah.
You have to pick them up at their facility.
And
the authorized purchasers, they have to arrange the breaks.
Yeah, the collectible coins, they have, the markup on those are like, 30%.
So that $2 spread, they're not shipping them anywhere. They're just saying, okay, here's your coins. You come over to our house and pick them up. You arrange delivery, insurance, and everything. It's $2 just for our little eagle stamp on Silver Blank.
Yeah, so I think we need to do a Kickstarter campaign. Maybe list it at $10 million. It'll fail. It'll never work. But of course, it's great for public relations and spotlighting the issue.
It certainly would rub some egg in their face.
Yeah, anybody in our listening audience, if you want to do a really good job putting together a Kickstarter campaign, we'll put some links up on the Silver Doctors and the News Doctors. Maybe Bloomberg will pick up the story. Who knows? All
right, I think we'll end the show on a light note there today, Eric. So I think that's a good place to wrap. So for the Doc and Eric Dubin, thanks for tuning into this week's SD Weekly Metals and Markets.